Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
And we're back again, like it or not. Feel free to call us 216-901-0945, 216-901-0945. Got a lot of good stuff to talk about this morning. And I think I'll start off by kind of promoting the upcoming seminar. They're free, which is always good. We always have refreshments there that are done by 4- and 5-star chefs that work for Tri-Cities Corporate College. That I can't remember where they came from. I'll have to ask again. There were some pretty big restaurants, big hotel chains. I'm sure they've actually gotten people from the Ritz over there. I know they do. So that's a really fun thing, and doesn't cost anything, which is kind of nice. And that's actually going to be Thursday, September 20th. It's going to start at 6:30. And the main topic is the highest rate of return that you can get on quote unquote safe investments. And anyway, so it should be a lot of fun. No cost to attend. Seating is limited. You can go to bullingtoncapital.com to sign up for that online. We'll be doing some pretty interesting things between now and then. I'm going to put up the Lookout for the Bull website again. It'll be different this time. We're going to start it off with one of the things that we're going to be talking about at the workshop as well. One of the safer ways to invest in stocks. And I'm going to describe exactly how to do that. We're going to be posting, actually, myself and Michael Seeger, the guy that was here last week with me, the intern who's going to Case. He's going to actually be running that thing. I'm going to give him the data. I'm going to put out the material, the educational material on it, and it'll be a little subscription website that you can, subscribe to relatively inexpensively, and you can do some of the stuff that we're doing. If you don't want to call me, then we'll give you another option. You'll be able to look it up and do some of that stuff. And by the way, those are stocks. So that's why we're putting the quotation marks around the word safe, because stocks are very volatile, but there are a lot of things that you can do to take a lot of the risk out of it, or at least reduce it. You'll never be able to eliminate all of it. That's just not happening. In fact, the risk with the stocks is pretty high. And a little bit later in today's program, we'll talk about a few stocks that have come up in conversation this past week that I thought were very interesting. So stay tuned for that. I think one of them has a pretty decent opportunity. Others are stocks that people have asked about that are good companies, but have really high valuations. What does that mean? That means, let's say you're buying real estate and you're looking at a house, you really love the house, and the house is selling for $240 a square foot in a neighborhood where all the other houses are selling for $140. Okay, that means that if you really like that house and you buy it, you may have to wait an incredibly long time to be able to sell it and get your money back. Now, if for some reason that same house goes up for sale and it's only $100 a square foot because something happened, people have to move quickly and they're willing to take a whole lot less money, then that might be a really good idea. So that's kind of what we're, stocks do that all the time. And again, we'll be talking about that in a little more detail later on in today's show. And if you guys have any topics that you'd like me to talk about, feel free to email me, bill@bullingtoncapital.com. I've been doing this show since 1996. Think about that for a second. 1996. That kind of blows my mind. And it gets a little hard to find topics to keep talking about. So if you have any questions, feel free to email me, bill@bullingtoncapital.com, and I would be more than glad to try to address those on the show. In fact, somebody did send me a message, and I'm in my email trying to find it right now. While I'm looking for that, I have to tell you, this is really good news. This is really good news. If you work for the Cleveland Clinic has Fidelity handles most, I think 99% of their retirement plans, if not 100%. And they have picked a lineup of funds there that are very diversified, which is what you're supposed to do when you run pensions. You want funds that don't have a lot of overlap in them. You're supposed to do that. And what that presents is an opportunity to come in and it's not super highly active management, but it is active management. And you can come in and I'm sure you can add value by monitoring and making adjustments along the way. And in fact, I used to do this for several people. Their platform has improved, by the way, over the last 3 years. It's improved a lot. Most people are not taking advantage of that. They're just not. And it's a really good program, and there's a really good opportunity. We'll be talking about that at every workshop going forward. I think I might even start to do workshops just for people who are in this. And because of the tool that I just recently subscribed to, the tool that I'm going to be using, it really opens up a great opportunity, I think, for people who may not know a whole lot about managing money, may not know a whole lot about the funds they have available to them. What would be the time to buy them? When's the good time to sell them? Just coming up with a strategy for utilizing that. And we've got one that I think is really good. And it's we've been working with people in the past on this, but it's improved. Just within the last week or so, what we're doing with that has improved. And so I would call out the names of the people that had asked me to look further into this recently, but I didn't get their permission, so I guess I won't do that. And it's a new development, so I'm really excited about that. So if you work for the Cleveland Clinic and you're listening and you want some help with your retirement plans there, the optional ones, the 457, the 403Bs, we've got help for you. I think it's going to be a really big deal. At some point in time, probably do a meeting downtown near the main campus for anybody that wanted to come by there, because the opportunity that you have is I think is a really good one. You're hearing a lot of stuff about this being the longest bull market in the history of the market. Well, you know what? When you drop 57%, what do you expect? Yes, the recovery is going to be a good one, because the disaster was a big one. You've got to go back to the Depression to find things that were that bad. Okay, so realistically, there are a lot of reasons this market could keep right on going. I would not expect a huge correction over the next year or two. I just wouldn't. There are a handful of stocks and the S&P 500 that are overpriced. Big deal. You're always going to have that. They do happen to make up about 25% of the index. So what does that mean? If those stocks go down 40 or 50%, then the S&P is going to be down 12.5% or so, assuming that the other stocks don't receive any of the money that's come out of those stocks. If that happens, then the S&P goes flat or actually creeps up a little bit. And a lot of the categories that have not performed that well over the past 5 to 10 years are starting to kick back in now. That's a good thing. That's a really good thing. How do you position yourself for that? Well, one of the things I would really look for is value. I'd look for value. What is value? Well, get to the workshop. We'll talk about it in detail. When you're driving, describing value investing, really difficult, because you can't stop and look at the math because you're driving. At least I hope you're not looking at the math, trying to figure this out while you're driving. Pull over. Value investing is basically saying, hey, look, I know I'd like to buy this. I think this is a good company, but how much should I pay for that? How much should I pay? And with value investing, you can even invest in kind of crappy companies because they're so cheap. If the price is crappier than the company, then there's an opportunity. And by the way, that's safer than buying a good company and overpaying for it because it's a good company. That's what people do all the time. They buy something, they overpay for it because it's a good company. And then when it goes through a normal correction, or if the business for some reason struggles for a year or two, that stock will be down 50% and sideways for 5 to 10 years. What kind of sense does that make? Okay, in the short run, it may keep going up. It can. They do it all the time. See, an overpriced stock that gets more overpriced. NVIDIA comes to mind. And the Bitcoin thing, the mining, all that whole thing is 95% hype, by the way. There's 5% of it that's very legitimate. And that's significant, but it's not what people say it is. That's, people have a tendency to say a lot of things that, they get excited about. I understand. You get excited about it. That's one of the reasons that, if you want to be a successful investor in the long run, if you don't want to rely on luck, you got to learn how to do this. You can't rely on luck. I know a lot of people do. A lot of people do. I was looking at Ericsson, a stock that makes the handsets, the cell phones. I looked at that. I'm not even sure that's what they do anymore. In fact, I'll have to look that up. It's been so long since I looked at that company. But I remember the symbol. And the reason I remember the symbol is that I had a kid come into my office in the year 2000, and he had inherited $75,000 from one of his grandparents that had passed away. He put the whole thing in Ericsson, $75,000. When he was talking to me, it was worth $350,000. And you couldn't tell that kid that he wasn't a genius, that he wasn't right. And I'm looking at the valuation on the stock, and I'm going, man, there is no way. I'm like, dude, do you see this? Let me show you something. And he started getting really upset. I'm like, I don't know what you're upset about. The stock is still strong. For a while, I would probably you put all your money on red, and it came up red. Take your money. Well, anyway, that stock crashed, and it is nowhere near the price it was back in the year 2000. It's down over 80% from there. That's what I was talking about. In one of the plagues to knowing what you're talking about when you're managing money is that you're going to miss those opportunities when people get really, really, really lucky like that. You're going to miss that. This is not unique, by the way. I can't tell you how many times I've seen the same thing. Somebody bought a boatload of stock in a company that goes up 1,000, 2,000, 3,000 or 4,000%. And they feel like, I'm a genius. I got this figured out. I got it. No, actually, you won the lottery. You won. And eventually, if you don't learn, you're going to give it back. You'll give it back. So now the downside to that, obviously you're going to give the money back, but also you don't learn. You spent all those years you had holding that stock, watching it go up, thinking that you were doing the right thing, and you didn't. You wasted that opportunity to learn what it really takes to make and then keep your money in the long run. Making it's one thing, keeping it's another. Very difficult. It's kind of like in the general stock market, for a company to make it up into the top 1,500 in size, just by size alone, to make it into the top 1,500 is incredibly difficult to do. I mean, it's incredibly difficult to do. To get into the top 1,500 companies in the United States by size alone is incredibly difficult to do. Almost as incredibly difficult as staying in that top 1,500, because staying in there is is also incredibly difficult. In fact, one of the companies we're going to talk about a little bit later on today's program, this is a stock that this is not an investment, actually. What I did, I have a very small amount of money that I will actually make a highly leveraged investment that's at the top of the risk pyramid. That's why I only do it with a little bit of money, and that's what I've done with this company. And I'll be explaining a whole lot more about that, in the last section of today's show. So that's something I don't want to start off with, because I'll end up getting a lot of people writing it down and going out and trying it. Probably shouldn't do that. Yeah, I'll wait till the last segment when nobody's listening. I'm just kidding. But it is fun, and that's the one thing about stocks. They, you never know. If you look out over 10 years from now, there's a pretty good chance that the stock market's going to be up a whole lot more than it is today. There's a good chance it'll be up more 5 years from now than it is today. But 10 years, the chance is much better. And I'm pretty sure it's probably going to beat the 3 or 4% fixed interest rates that you can get from something that's semi-safe. You can't get a 4% super safe investment right now. You can get around 3.5, 3 in that range. Again, we'll be talking about that in more detail at the workshop. That's going to be September 30th. That's a Thursday, by the way. It's at 6:30. Go to bullingtoncapital.com to sign up online. There is no cost to attend. And we're going to have a lot of fun there. Highest rate of return you can get on, quote, safe, unquote, investments. I just realized I hardly ever finish in a complete thought when I'm on this show. It would help if somebody would call, by the way. So if you want to call the question with the question, the number is 216-901-0945. We're going to be going to a commercial break in a couple minutes here, but the 216-901-0945. You can always email me as well, bill@bullingtoncapital.com. I'd be glad to try to take a look at whatever it is you wanted me to look at. And I am having trouble finding one of the emails that we got, that I got. I'll take this commercial break to try to locate it. You listen to Bill Bullington here on 1420 The Answer. Stay tuned. I'll be right back.
It hasn't happened yet. I'm wide awake in the middle of the night, scared to death. So I pray, God, would you make this stop? Father,
And so we're back. You're listening to Bill Bullington right here on 1420 The Answer. I'm here every Saturday morning from 11 to noon. If you'd like to learn more about me or my firm, you can go to bullingtoncapital.com. You can sign up for that seminar that we have coming up, where we're going to be discussing safe investments. And I did find the email. I found the email that was sent by a listener, and he wanted to know if I could explain what existing shareholders should think when a company announces the public sale of shares of their stock. And, well, what you can think about it is, and you're absolutely right, that the shares are diluted. See, when you add shares, at the board of directors, takes a vote, they're going to add shares. They're going to sell those shares to the public. And what they're doing is they're selling pieces of the company. That's what shares are. It's a piece of a company. So when you add more shareholders, that means if you're going to pay a dividend, you're going to have to pay a dividend out to more people. So the profits are going to be split up amongst more people. And that causes this thing they call dilution. It's diluted. You're diluting the earnings per share, because if you're going to pay out a dividend, which comes directly from your earnings most of the time, then you're not going to be able to pay out as much, or you're diluting those profits by spreading them out over a much larger share base. 2 million shares is kind of a lot, actually. So, what should you think? Shouldn't you be upset? Well, You can be. It depends on how many shares they already have outstanding. You want to take a look at that, see what kind of impact it's going to be. But generally, it's not that good of a thing. When you add shares, you're bringing on new partners. You're diluting your ownership. Let's say you owned 10% of the shares before, which probably a multi-hundred millionaire if you own 10% of a publicly traded company. But anyway, and the company comes out and adds a whole bunch more shares. Well, your 10% may drop down to 9, 8, depends on how many shares they bring out. So you don't have as much influence over the company anymore because it's all done by the percentage of shares that you own. So yeah, that's not a great thing. It's not a great thing when that happens to bring out more shares. Occasionally, a company will do that because they need the money. They need the money to be able to buy something or go into other businesses. And so and if it works out, if it works out really well, and now their sales and their profits grow, and then they can do the opposite and start buying shares back. So sometimes it's a good form of financing, but it's risk. It's risk, and you are diluting the ownership of the existing shareholders. They don't have as much say. They don't have as much high a percentage as they did before. So yeah, should you be upset? I don't know about it. I don't know that upset. I think you have to look into it. It's generally not a good thing, generally, but it can be. So you just have to look into it, and it's on a one-off basis. So it's going to be whatever it's going to be, and you do have the choice, by the way, to sell the stock that you do own. If you don't like what the management is doing, you can sell your stock. That's one of the great things about the stock market. It reminds me of the United States. Being a democracy, being able to vote. You don't like who's in office, you vote for somebody else. Yeah. And if everybody gets tired of somebody, they're gone, and you don't have to shoot anybody. You don't have to have a war, nothing like that. It's a really good positive thing. It's a positive thing. Same thing with capitalism. You're free to invest wherever you want. If you don't like what they're doing, you're free to take that money and go someplace else. And so that's a beautiful thing. Which reminds me back to, we're talking about the workshop and about the website. Look Out for the Bull is coming back. We're going to start Look Out for the Bull with a value-oriented model. There are a few reasons for that. First of all, it's more traditional. It's a buy low, sell high type of strategy. Secondly, value stocks have not done nearly as well as growth stocks have over the past 5 years or so. And when that pendulum swings back the other way, and it looks like it started about a year ago, value stocks have become much more popular now. They're starting to close that gap. In the long run, value stocks have outperformed growth stocks. So logically, if they've underperformed for the prior 5 years, what do you think, and they're going to outperform in the long run, what do you think you might want to be looking at? Exactly. You want to be looking at value-oriented stocks. And if you've already been in those value-oriented stocks and you've seen the slightly overpriced stocks go up and get slightly more overpriced because they're growth stocks and that's where all the money's been going, now you've been wondering why your value stocks have started to do better suddenly because you don't see a whole lot of progress in the growth stocks. Well, that's kind of why. Money is kind of starting to shift and go over into those other areas that have underperformed for quite a while. And again, that's one of the reasons that, if you've got a plan kind of like the Cleveland Clinic. Now, by the way, I want to try to develop this for the police and firemen too. Yeah, they've got, their deferred comp programs. I think you'll be able to do this. I'm pretty sure we'll be able to do this for the police and firemen. So it's something that we're going to spend. You'll spend some time once a quarter looking at all the funds that are available, reallocating your accounts, trying to stay in the those that have best performance, and make a difference. Make a difference. Hopefully, all this effort will make a difference in your the amount of money you're able to accumulate for retirement, because that's a big deal. You look at all the statistics on retirement. Most people are going to have to keep working for quite a while. I don't mind working. Yeah, I really don't feel like I work. I mean, I feel like I'm doing what I really like to do, like all the time. There is a bunch of paperwork. That part, I'm not a big fan of that. I will tell you. That's work. That's really work. And especially the way that things go. I mean, it's just unbelievable how much technology is supposed to work and doesn't. Well, it doesn't work like it's supposed to. I should put it that way. Every time we turn around, something else is not functioning, and we have to stick it out and make it, work with the tech support, because our clients are dependent on that. Yeah, so are we. So that's one thing I've noticed over the past few years, and it seems like it's just been accelerating. The past few years, the technology's been changing so fast that a lot of the old technologies, it never worked. So they skipped it and went on to a new technology, and sometimes, more often than not, it'll actually work better than the old technology, but they don't bother fixing the old technology. They roll out an entirely new platform, and it's hilarious. We've been victims of that just constantly over the past 5 to 6 years, and it seems like it's really accelerated. I'll give you an example. We have this service that we provide clients. You can log on. You see the accounts that we manage. We load those up for you. You can add any others that you want to. It's called an account aggregator, where you can add your checking accounts, you can add your savings accounts, credit card accounts. You can put your mortgage on there and get your statements. And you can put trust documents in there, your key contacts, kids' information, whatever you want. We call it a financial portal. Okay, so this financial portal that we're putting together, that we've subscribe to and make available for all of our clients. They go in, they log in, and they hook up their 401k plans, their checking accounts, so they can watch it, see everything in one place. I love that service, by the way. I think it's a great service. I think we have all of about 5 people that are actually using it. I pay a lot of money for that. It's a very good service. Tracks all your spending for you, which is what I use it for. But anyway, we've got about 5 people using that, and it breaks constantly. Why does it break? Well, it breaks because all the financial institutions out there cannot agree on a security protocol that is going to be uniform across the whole spectrum. Now, they should have, my personal opinion, and it'll go this way. It's going to be biometric. You know those little pinhole cameras you have in your laptops? That can read your face. They can do facial recognition. They're doing it now. They're already doing it. So you'll do finger recognition, and then you'll swipe your finger across your a key on a MacBook. You just press your finger down on a little area, a little piece of plastic, and it recognizes you. And that would be really hard to fake. And they can also use voice print. So it has the microphone. Your voice print is as unique as your fingerprint. So you add those 3 things together, it's going to be really hard to hack your account. That technology is already here. That's what's coming. It's going to get easier, so we're just sucking it up during this hard period as all these companies keep changing their protocols, and you have to keep reestablishing the links between your accounts and your account aggregator. But that's something that we do for our clients, and we've offered it, and some of them are taking advantage of it, very, very small number, and they use it in different ways, which is fine. Everybody uses it a little bit differently. Basically, I set it up so that if a transaction goes through on one of my accounts that's more than $500, it emails me immediately, and I get a text. I get a text and an email. How cool is that? I mean, so it's watching all my credit cards. I don't have that many, but it's watching all my credit cards. It's watching my checking account, and if a transaction goes through that's more than $500, I immediately get buzzed. So I check it out. If I don't recognize it, I just get on the phone. And by the way, it hasn't happened yet. I've recognized all of them. But if something were to go through that's a large thing, I can call the credit card company immediately and get that fixed. So I think that's a really good service. The other thing is that at the end of the week, when I download that week's transactions, which I typically do Saturday morning before I come in to do the show. Yeah, if I do all the transactions that occurred that week, it takes all the transactions from all the accounts and puts it on one spreadsheet. Now, it's also saving that information. By the way, the company is called eMoney. It's owned by Fidelity. I pay Fidelity for access to their software, to that service, software as a service, and they've got tech support and the whole 9 yards. Anyway, very good service, makes my life significantly easier. And more of my clients, if you're out there and you're listening, and you've heard me talk about this in the past, I'm going to continue to talk about it because it's going to make your life easier. Makes my life easier. Makes both our lives easier. And it's something that a lot of people just really aren't taking advantage of. And I think that they probably should. I can show you how I use it. You can come into the office if you're a client. If you're thinking about becoming a client, you can come into the office. We'll show you how to set it up. We'll help you set it up. If you have problems, we have to actually contact their tech support. We're kind of the intermediary there. We'll step in. We'll contact them. In fact, we just got one fixed this week. There was a link that went down, and the company was going through some change. They already knew about it by the time we had contacted them, and they were working on it, and they finally got it done. And it took, 8 or 9 days. Do you have really 8 or 9 days that you want to take out of your life to follow up on something like that? I don't think so. It's one of the reasons that we get paid. And it's one of the things that we do that a lot of the bigger firms don't. They just don't. They don't do what we're doing. And I'm amazed that people aren't taking more advantage of it. I would. But once, I haven't had any problem with my account now. I don't know. I can't even remember how long it's been since I've had one of those links break. That's typically all that can happen is, link breaks. You got to go in and reestablish the link. Big deal. And I love taking the downloads, saving them myself to another folder, by the way, through you can actually put it in the digital vault in this program. So you could save this, all your transactions for the week. Then you take the Excel spreadsheet and you re-upload it right to the website, and you just label it, put the date on there, and now you've got that forever. You got that forever. So that's pretty cool. Anyway, boy, that subject's going over like a lead balloon. Phones are completely dead. Probably why so many people aren't using it. I know you have to be kind of a geek to kind of like that stuff. But that's okay. Speaking of being kind of geeky, there's a company, and I guess I'll be starting a little bit early. We're going to go to commercial break here in a couple minutes, but I'll start a little bit early and start to talk about it. There's a company. It's called GameStop. Everybody recognizes them from the video game stores that they have in the country. What they don't realize is that these guys are the largest direct distributor of Apple products outside of Apple itself. They have thousands of stores that sell nothing but Apple products. You can go in there and get service, and just like one of the Apple stores. They also have a something with I can't remember. I think it's AT&T, and it's their T-Mobile. It's either AT&T or T-Mobile. I'll look it up. But anyway, GameStop does this, and then they have a couple of other stores. They've got an online magazine that's really popular with gamers, and they sell a whole bunch of stuff. Gamer, I call it paraphernalia, but yeah, they call it something else. I forget. They got thousands of those stores. Anyway, the reason I bring this up is the valuation on that stock is very, very low. Now we're going to have to talk more about that after these messages. This is Bill Bullington. Stay tuned.
I have seen your hurting heart, and you feel so lonely, but you keep on hiding, 'cause you feel so guilty for what you've done, but there's no
And we're back. Hey, if you got a phone call, question, and comment, 216-901-0945. Got a caller hanging out there. Don't know who he is because he's not up on the board. But anyway, if you want to call us, feel free. Also, you can go to my website, sign up for the seminar that's coming up. And that's coming up pretty quickly. It's September 20th. Should be a lot of fun. The highest rate of return you can get on quote unquote safe investments. Or you can just call me 330-664-0700 in the office. And I did get a couple of emails I didn't get a chance to get to. I was out of the office a lot of this week. So if you've emailed in the past week or so, give me a little time. I'll be able to respond to all you by Monday. So now I'm going to go right to the phone. And is this Bill?
Yeah, good morning.
Hey.
Say, Bill, I read an article the other day about Bernie Sanders wants large employers such as Amazon, Walmart, and McDonald's to fully cover the cost of food stamps, public housing, and Medicaid and other federal assistance received by their employees. Essentially, the government right now is subsidizing benefits, if you will, for these low-paid workers. And I wanted to know if you think that's an important consideration when you go to decide to invest in a company like Amazon, Walmart, and McDonald's, who don't really pay their workers a living wage.
My personal opinion on that is that if this is a personal opinion, and it's not political, it's economic. I don't think if you can't pay somebody enough to be able to live on the wage that they're earning working 40 hours a week, you don't have a job. That's not a job. Yeah, I think you should be able to pay them a livable wage. If you're going to employ somebody for 40 hours a week and they're going to work hard, the people at McDonald's, they work really hard. Watch those guys sometime. And I worked in a restaurant when I was young, when I was in high school. And I just don't think, and that's my personal opinion. So I think if you can't afford to pay somebody enough to be able to live I'm not talking about an elaborate lifestyle, and certainly more than the amount that they're going to get on welfare, because you can't live on welfare either. That's impossible. You're forcing a lot of those people that live on welfare to go out and do things under the table to be able to get by. So, yeah, I guess I would be, I don't know that you can hold the companies completely. Yeah, well, actually you can. You can say, look, if you don't have if you can't afford to pay somebody a living wage, then you don't have a job. You just have to get that done with the workers that you are paying a livable wage to. And that would kill a lot of industries, by the way.
Well, I mean, the thing is, you look at companies like Amazon, who's immensely profitable. They can't afford to pay a living wage to their employees, but they choose not to because they're looking to maximize shareholder value for the benefits of the shareholder. They're not taking anything else into consideration other than just profits.
Well, and I don't know, because quite frankly, I haven't looked at Amazon in a very long time. I don't like to look at stocks that are overpriced. So and it's not grossly overpriced. It's overpriced. It's too much. They're asking too much for the stock, or the stock is selling for too much relative to the underlying value. There are a lot of things about Amazon I'm kind of wary of, but Jeff Bezos has definitely done some amazing things. Are they able to pay livable wages? I don't even know. I don't know what the people that work at those warehouses earn. I don't know if they have health insurance. I don't know anything about what goes on at Amazon. I just do know that a lot of companies are employing people that are working an awful lot of hours, and they can't afford. They would be better off on welfare, and that's not a good thing. I just don't think if you don't have a job that you can afford to pay somebody a livable wage, then you don't have a job. That's not a job. Yeah, that's something you wish you could get done, and you can't get done without taking advantage of somebody. So I guess the
big problem I have is the fact that these companies aren't paying a living wage or offering benefits. Then it ends up on the back of us taxpayers who have to subsidize the Medicaid, food stamps, and other assistance programs for these employees. So essentially, we, the consumer, are paying for benefits that these companies should be paying on their own, and I really feel that's wrong.
Yeah. Well, and by the way, if they did pay them a livable wage, you know prices would go up, and we would end up paying for it anyway. So that's what would happen. But yeah, I understand it completely. You know, and I'm there with you. I think personally, if Bill Bullington were king, then I would pass a law that unless you can pay a livable wage, you don't really have a job. There's no job there. You'd have to have a livable. And by the way, I would be assassinated like quickly. I would be a lot less popular than Trump is, like maybe 10%.
Got it. Okay, Bill. I appreciate your thoughts.
All right. Well, thanks for calling. Yep. Yeah, there are a lot of things, and you know there are a lot of problems in the world that don't have good solutions right now. There are a lot of them. I mean, they do. You could solve them. It would take an incredibly large amount of willpower and political willpower to get those things done. I really don't think it's right that you ask people to work as hard as they work in a fast food restaurant and give them minimum wage. No way. Yeah. So the problem is they would have to raise prices to be able to pay that kind of money. And you know what? Personally, I would pay it. I don't eat a lot of fast food. I should have bought Starbucks stock back when it was $10 a share about 5 or 6 years ago. I spent most of my you know what? Now that I think about that, I think most of the money I spend in restaurants it's at Starbucks. Because yeah, it is. That is funny. That's hilarious. And Starbucks pays better than average wage. Yeah, and a lot of people that are working there, and they have a program where they pay for college. And I'm not sure if they pay for health benefits. I don't know. But so I think that's, but Starbucks also charges me close to $5 for a cup of coffee. So, yeah, I guess, under that scenario, you can probably do that. And there are some businesses where, maybe they're not charging enough to be able to pay that. And that's a quandary. So, yeah, it's tough. It's tough. There are a lot of problems in the world that, just don't know what the answers are to. I think that at some point in time, it does get better. You look around today, things are a lot better than they were when I was a kid. We had 3 television stations, or 3 channels, rather. 3 channels. And when the president was talking, your night was shot because those 3 channels were all showing the president. And when you're 12 years old, you don't want to watch the president. The president's the last guy you want to see. Yeah. Anyway, today I've got I don't even have cable anymore. I have no cable. Actually, they are coming to install it, but it's not to put the cable in so I can get the internet because I actually use YouTube TV. And it's a streaming service. Somebody told me about another streaming service I'm going to check out shortly. But anyway, I've got a few minutes left here. If you heard anything on today's show that you'd like more information on, feel free to go to my website, it's bullingtoncapital.com. There's a contact us button there. You can reach out to us. We will try to get back to you this week. We've had a few people, and I've been in and out of the office for a couple weeks now. I'll actually be out a little bit this week, but I've got Monday and Tuesday to return and answer all these emails that I've sent. I think there are only about 5. But I'll be glad to get back to answer any questions that I can. If I can't, I'll find out who can answer the questions. We'll try to get that answered for you. One of the things that we've been working on for people is really this program with the Cleveland Clinic. I'm really excited about because Clinic is one of the bigger employers. I think they're the biggest employer in Cuyahoga County and one of the bigger employers in Summit County. So you've got a really good opportunity there. You've got a retirement program that it's a really good plan. And if you want help with it, we've got models that tell you which funds to buy, which ones to sell. We manage money there for people that are working there. So we're going to bring you up to speed on that. If you're not doing what we do there, I would just suggest you get the, whatchamacallit? My mind is going on me, the target date funds. If you're not going to spend time managing it, just go with the target date fund. If you don't know what a target date fund is, call me or let me know. But if you're not going to do the target, if you're not going to spend time or you're not going to seek help with that, then just get the target date fund. Because you know what, those funds are very good. The plans are extremely good. And Fidelity does the administration on it. They've got different money managers within the plan, but Fidelity does the administration on those plans. Do you know Fidelity handles more retirement accounts than Social Security Administration does Social Security accounts? Isn't that amazing? That firm is huge. It's one of the reasons we use them as one of our custodians. Now that I hear the music, that means this show is over. You've been listening to Bill Bullington. I'm here every Saturday morning from 11 to noon on 1420. You can also catch this as a podcast on 955thefish.com if you'd like to. Have a good weekend, everybody. Good luck and good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.